Hello and welcome to Structured Finance in Focus, a Fitch Ratings podcast that takes an in-depth look at the latest developments across the global structured finance market. I'm Drew Smith, the director at Fitch, and on today's episode, I'll be discussing the UK and Dutch mortgage markets with Cristina Pagani and Vincent Dobbelaar, both also directors at Fitch. To kick off, I think regulation in the buy-to-let space may be an area where there's some shared experience across the two jurisdictions. Starting with the UK, Cristina, what are we expecting to see on this front?
We're definitely expecting to see two major reforms that are coming in the private rental sector. So first of all, the government is progressing a renters' rights bill, which is expected to be implemented in 2025. And we have two key highlights. The first one is the abolition of Section 21, or no-fault eviction, which currently can be used to evict tenants without a specific reason. And the second one is actually stopping fixed-term tenancies, and all tenancies will be periodic, and renters can live with a 2 months notice, and this is effectively preventing renters from being trapped in substandard properties. So overall, we do not expect the bill to significantly affect the performance in the buy-to-let sector, as, for example, possession can still be gained and rents increased as long as each one is on fair terms. The second main reform is the Plan for Change, EPC legislation, as the government is proposing that to let a property in England and Wales, an EPC score of C will be required from 2028 for new and from 2030 for all tenancies. A 15,000 cost cap is still applicable though, which means that the lowest performing properties can continue to be let without meeting the C score, although some improvements will need to be made. Overall, how do we see this? The targets presents definitely additional costs affecting landlords, but we do expect average energy efficiency scores in the private rental sector to improve.
Yeah, so looking at buy-to-let regulation in the Netherlands, generally regulation is more favorable for owner-occupied mortgages as compared to buy-to-let. First of all, on income tax deductibility, that is only possible for owner-occupied properties and not for buy-to-let investors. Then the transfer tax for buying properties is between 0 and 2% for owner-occupied properties and at 10.4% for buy-to-let. So that is quite a large gap. Then importantly, in July of 2024, additional rent caps were introduced in the market, covering the so-called mid-market sector. Now in the Netherlands, there's a point-based system to score properties, and for a larger range of those scores, a maximum rent now applies, which is of course reducing returns for many buy-to-let investors. So as a result of that, we're now seeing increased divestment by to-let investors, and especially the smaller private investors, which have been the core of the Dutch buy-to-let RMBS market. It's also leading to lower lending volumes in buy-to-let lending and additional sales of properties to first-time buyers in the owner-occupied market.
So moving on to mortgage performance then, and starting with the UK again, Cristina. What have you observed of late in terms of arrears and defaults, and how do you see this developing moving forwards?
So if we look at the UK finance data, both owner-occupied and buy-to-let 3 months plus arrears came down in the past year, and this is mainly due to real wage growth and interest rate reductions. So overall, we expect that arrears in prime and buy-to-let sectors will slowly decrease in the next 2 years, mainly as interest rates stabilize and underwriting policy remains sound. Different story in the non-conforming sector, where performance is still somehow concerning. 1 month plus arrears have stabilized, and 3 month plus arrears are slightly increasing, but show signs of leveling off. And we also expect defaults in the non-conforming sector to grow. We have actually seen non-conforming loans incurring higher than expected losses in recent years. So if we look at loss given default data, this has indicated the losses between 10 and 30% across various non-conforming collateral. But this is coming from a limited observation across several service repossession activity, and activity overall has been limited. So observation may also be skewed towards the worst instances of arrears. Overall, and to conclude, we do expect ongoing performance to remain weak in the non-conforming sector.
Yeah, so looking at the Dutch market, performance measured by 3 months plus arrears has trended downward over the last decade and is now at stable, very low levels. One good other statistic to illustrate the strong performance is the number of foreclosures, which is reported for the total market. Now there were 240 in 2024, and there had been around 2,000 in both 2013 and 2014. Now, the drivers behind this strong performance are, first of all, the property prices. So they are up 110% over the last decade. So the vast majority of borrowers has substantial positive equity. Now, there are, of course, borrowers getting into financial difficulty, but in most of the cases, this is resolved by amicable sales. And in the end, those cases don't show up as defaults or foreclosures in RMBS transactions. The second driver behind strong performance is the underwriting regime. So it is heavily regulated since 2014 and provides detailed guidance to originators on how to do the household budget calculations. And this has led to low DTI ratios observed in most Dutch mortgage portfolios, which leads to strong serviceability of the debt.
So turning to home prices now, I believe we've seen some appreciation in both jurisdictions, but to differing degrees. Firstly, Vincent, what's the story been in the Dutch market and what are we expecting going forwards here?
Yeah, so Dutch market saw a very strong increase in 2024 at 11%. And we're currently forecasting a further increase of 6 to 8% for this year and 4 to 6% for 2026, which is slightly lower than what we previously forecasted as a result of the recent rises in Eurozone interest rates, but of course are still quite high growth figures. Now, price growth is driven by a few factors. First one is limited supply. There's not sufficient building going on due to high material prices, limitations on available land with the right permissions, and also because there are caps on nitrogen emissions in the Netherlands, which are linked to EU legislation that's particularly impactful for the Netherlands because of the high population and the intensive agriculture. If we look at risks for the housing market, the inflation is quite persistent in the Netherlands at 3.7% at the moment, which is well above the most other countries in the Eurozone. And there is a risk that the wage growth, which is currently also high, cannot keep up in the medium term. And there is, of course, also a risk linked to geopolitical developments, such as the trade restrictions, as the Netherlands is a very open economy.
If we look at the UK home prices growth estimate for 2025 and 2026, this is in the 2 to 4% range. If you look back at 2024, we believe that the principal reason for increased prices was the reduction in interest rates. Lenders have already priced in policy rate reduction for 2025, so this has limited room to spur price growth. But some other factors that may support growth, nominal wage growth, for example, expected in the 3 to 5% range in 2025 and 2026, combined with a smaller reduction in mortgage interest rates. Then if we look at volume of sales, rising volumes could be supporting of UK house price inflation and have actually increased in the past year, but remain volatile, somehow contributing to an element of volatility in home prices. Last, looking at supply dynamics, the government has committed to build new homes, but we believe that effectively there will be not enough new supply to materially affect prices this year.
Thanks. So a final question for you both then. What's one interesting trend or highlight you pick out from your respective markets that you can share with us?
Yeah, so for the Netherlands, there's a large part of mortgage production which is being guaranteed by the state through a scheme called the NHG guarantee. For a long time, they've always charged the end borrowers 60 basis point as a guarantee fee. And now, since the start of 2025, they have reduced it substantially to only 40 basis points, which will further increase the attractiveness of this scheme to borrowers because the guarantee translates into lower interest rates.
For UK, I would pick the lifetime products, which have marginal increase in the last quarter of 2024. However, figures from the Equity Release Council indicate that the total annual equity release lending for 2024 is much lower versus the peak in 2022 when interest rates were at their trough. However, we actually noted some recent innovation on the structuring side, and such innovation aimed to broadly achieve efficiency in terms of capital requirements and can actually enlarge the investor base and somehow boost interest in securitizing both new and seasonal long-duration mortgage product. In our view, product innovation is needed, especially to provide somehow efficient solution for borrowers, as many non-conforming loans are scheduled to reach maturity in the next 8 years with a peak in 2027. We noted that the ability of many borrowers to meet their bullet payment is still uncertain.
This brings us to the end of our discussion. Thank you for joining us for this podcast on the UK and Dutch mortgage markets. For more on this topic, you can find the Mortgage Market Index for both jurisdictions on fitchratings.com.